Hey guys, it's Christian, your local realtor, and for today's video, I want to look at a comparison. Let's compare an investment in gold versus Vancouver real estate, and where would you make the most money? Now, why do I want to do this video? I want to do this video because I meet people who are big on gold, big on precious metals. In fact, I've got a friend who's a gold bug, and he's always talking to me about it. And so let's do the money math, and let's just do it short and sweet right in this video together. Now, let's imagine a scenario where you have your maternal grandparents take $20,000 of their savings and invest it in gold, and then your paternal grandparents take $20,000 of their savings and invest it in a down payment in a house. And they're going to do this in 1982 because we need to give some runway to compare what happens over time. Let's go back to 1982. You got your maternal grandparents are going to take $20,000 and they're going to convert that into USD, which is going to give them a little over 16,000 US dollars, and they're going to buy gold. Now, the price of gold in October 29th, 1982 is $423.25 according to the records. So now that's going to get you 38.3 ounces of gold. By the way, an ounce is literally 2 tablespoons worth. It's not that much. In fact, if you took all the world's gold and melted it down, you could fit it inside of a hockey rink. Your grandparents decide they're going to set and forget. They're just going to sit on this savings, as this investment in gold, for the next 40 years until today, 2022, in the fourth quarter. And the price of gold has shot up, of course. It's gone from $423 to today's $1,632.38 an ounce. So the price of gold has gone up a lot here. I mean, it's almost gone up 3 times. Now, they've decided they're going to sell that gold, and when they do, they have $62,533, not bad. And of course, you're going to convert that back into Canadian dollars, and at today's exchange rate, you're at $1.37 Canadian. So that's how much you would get with $1 US. So the final sum total here is that initial investment is going to grow to $85,698 Canadian dollars, which is, it's just a little over 4 times. So you would think that's pretty good. Well, let's find out what your paternal grandparents would be walking away with today if they had bought a house in Vancouver's real estate market. Now, to do this, let's say they're going to buy a house on Vancouver's east side, and the average home price, as you can see on this graph, is about $100,000 in the Greater Vancouver region back in 1982. And so they're going to put a 20% down payment. That's where their $20,000 is going. The remainder comes in the form of a loan from the bank. Now follow the blue line here. Look at the growth in value over the long run. We're going into the 90s, the 2000s, and of course we get the 2000 teens. Up to 2022, what we can see is the average value of a home is now over $2 million. Now, what we're going to do is assume a couple of things. One is that they had a 30-year mortgage. They've paid that off, so they own their home clear title. Now, let's say they haven't done a lot of renovations. The home's somewhat older, and in fact, it's land value. So we're going to take off $200,000 off of that $2 million. We're going to end up with $1.8 million. Plus, you've got fees, right? I don't come cheap. You've got legal fees, and etc. So we'll take off another $50,000, and we're going to say $1.75 million. So the final result here is your 2 maternal grandparents and then your maternal grandparents have wildly different results. One has about $85,000, and the other set of grandparents has a $1.75 million. Now remember, if they were to sell this as their principal residence, there is no tax on this, right? because all the way they had to pay interest. You cannot deduct the interest from your taxes here in Canada. So the one bone the government throws you, the one benefit you get tax-wise, is you don't have to pay any when you sell your principal residence. So this is a slam dunk, no-brainer in favor of home ownership versus gold. And a couple of things you want to understand. Why is this? Well, Warren Buffett has talked about this, and he often says, gold is really shiny, it's nice, you can caress it, you can fondle it, you can kiss it. But at the end of the day, the only way to really make money from gold is to sell it to someone for more than you paid for it, which is what we call speculation. So it doesn't really work. And Buffett's advice when it comes to gold is not to buy it at all. And the way to think about it really is that gold doesn't produce anything for you, right? It's generally been used as a hedge against inflation. Even there, it's not doing all that well in the last year, as we've been running at 6 to 8% inflation here in Canada, and the price of gold has actually gone down somewhat. Now, what you really want, Buffett always says, is income-producing assets. A farm, an apartment house. Like Buffett says, if you had a farm, it produces for you. You have, bushels of corn or bushels of wheat, which you can sell on the open market. Or if you owned an apartment house, obviously you could rent 6 or 8 rooms and be collecting rents. The rents will go up over time. So you're making money that way too. And that's the purpose of investing. You want assets that produce money, produce more for you tomorrow than they do today. And that's what you get with a farm, with an apartment house. You don't get that with gold. And so I hope that this video has been of help so you can see what the long run, in the long term, what the difference is between investing in, at least in the last 40 years, what the difference has been between investing in gold and investing in real estate. It's really a no-brainer. If you've got comments or questions, leave those below, subscribe, and we'll see you next time.